Miles is a mortgage broker, and he recently taught me some specifics on alternatives to the traditional mortgage that were very, very intriguing. I think it is going to really resonate with a lot of our Bank on Yourself clients and people interested in that who are on the call today. But he also was very good at helping me analyze potential real estate transactions. So I really wanted to introduce him to our group because when we meet a new client, I'd say the most common goal that gets shared with us is, my dream is to invest in real estate someday. My dream is to have rental income someday. And I know that the world these days with TikTok and YouTube and all of that crap, there's so many people out there pretending to be experts that don't really know what they're talking about. I fear that people might jump into that without having a partner or a mentor to accomplish those goals. So without any further hesitation, Miles, I'll hand it over to you, and you're free to share the screen when you're ready.
Okay. Yeah, thanks, Matt, Jeff, for having me here today. Happy Friday to everyone. Thanks for that introduction. Yeah, I wanted to just go through a product that I've run into, a mortgage product that I think is going to pretty much revolutionize if you have a current mortgage, how to really take advantage of your current mortgage, but also take advantage if you have rental property as well. And so I want to go through that, and let me share my screen and we'll get going.
And Miles, you're in the Longmont, Colorado area, right?
Oh, yes.
Okay,
Yep.
just making sure.
So I'm in northern Colorado. So
Okay.
we're going to get 60 degrees today, hopefully.
And I think a good probably 70-80% of the people listening or watching this later today are in Colorado as well. So
Oh, nice. Okay. Well, great. Well, great. So I named it Maximize Your Real Estate Equity and Grow Your Net Worth Faster. Does everyone see the screen? Are you guys seeing it okay?
Yep, you're good.
Okay, awesome. And so, who am I? Well, Matt's kind of already led into that, but I'm a full-time mortgage counselor and a real estate investor, specializing in helping homeowners and investors maximize cash flow and net worth. I've been personally investing in my own properties for the last 10 years. In that time, I've acquired over 120 properties, and I currently manage over $8 million in assets. I think I'm pretty close to being a pro, but a lot of it has to do with like experience in dealing with real estate and real estate investing. So what's the problem? Well, the problem is the 30-year mortgage. If you have one, it's slow, it's expensive, and the banks win every time. And with a 30-year mortgage, the bank has determined that their compound interest in advance when you purchase your property, that they will make from you over 30 years, typically doubling the amount that you borrowed. So at the closing table about 2 years ago, this was my own amount that I have to pay. So I financed $572,000. I'm going to have to pay the bank back an additional $577,000. This came directly from my closing packet. This is the amount owed, almost $1.2 million. So that's a huge chunk when you're thinking about, hey, how do I limit the amount of money that we're going to pay to the bank? And we're going to go through a solution that I found. You guys have heard of 30-year mortgages. If you have one, the pros where they were a low down payment, they're very familiar. They've been around for 100 years. They're readily available. And the payment is very dependable. It's fixed payments even with people with a stretched budget. But the cons is they're slow. They take decades to pay. They're very inefficient because the interest costs are paid primarily first within the repayment schedule. They're rigid, so they're closed end, meaning you can't take any money out of it, and they're expensive. And we're going to go through how expensive they are. In today's landscape, in a monthly amount, you're paying about 42% of your budget in the month to a mortgage, which is very significant. It costs a lot of money. So almost half the money that you have coming in goes out every month to the mortgage. And I think we have over $13 trillion that goes out the door every month
Wow.
nationwide, which is staggering. And even more staggering is the first 10 years, for every $100 you spend on your mortgage, only $23 is actually applied to your principal. And that happens over the first 20 years. After the 20 years, you start paying more of your principal than interest. So you can see where the bank wins. They immediately win all the way to about the year 21. And so it's very staggering. If you had a 3% mortgage, like a lot of people have, 3, 4, or 5 years ago, when you borrow 100 grand, you're actually paying back 52,000 dollars in interest, which is 52% interest. That's very staggering, even at 3%. And that's because it's compounded over the 30 years. People who have taken out a house in the last couple of years, 6% is a reasonable interest rate. When you're borrowing 100,000, you're actually paying back 116,000 in interest. So it's very staggering how much you're having to give back to the bank. And I like to show people and help them understand compound versus simple interest, and really, like, in the dollar sense, how much that actually is. So if you were to borrow $50 from me for 20 years over 15%, and we had that at simple interest, you'd be paying me back about $200. Now, what about $50 over 20 years at 15% compound interest? That's a staggering $818. Now, let's drop the compound all the way down to 8%. And even at a compound rate, you're still paying $233. So the question I have for you, is it the structure of the loan or the interest rate that makes the most difference? It's definitely the structure of the loan. Okay. But we're stuck in this 30-year mortgage. So what do? There's got to be a better way, right? And so there's a product called All-in-One, and it's been around for over 20 years. It's a solution to the mortgage itself. So you can pay down your loan faster. You can save time and money. You have 24/7 access to your equity. And in doing so, you live more security. Now, there's two things with this loan that I love. It provides two huge benefits. First, you can pay off your mortgage faster with less interest, and you have access up to 90% of the equity at the same time of your house. So in essence, the all-in-one combines your banking and mortgage together. By positing all of your income into your mortgage, you're accruing less interest over time, saving you thousands of dollars over the course of the loan. So essentially, your mortgage is now tied to a checking account. Your income goes in every month, lowering the principal balance, and then you're making periodic payments out of that, like utilities, cable bill, taxes, maybe once a year. So the longer your income sits into it, the lower the accrued interest on that over time. And that's really where you win. And any of these are, I'm just giving you guys broad concepts. At the end, feel free to put some questions in the notes. I'd be happy to answer some. And then also I can give you a custom analysis of your own current scenario as well at the end. Okay. Also, the second part of that is you can access equity. So you can access up to 90% of your home's current equity with this product. So the first 10 years, you can access up to 90%. And then it actually gradually lowers over time so that there is $0 left after 30 years. The loan is essentially done. Now, in between that time, if you want to redo the loan to another 30 years, you can. But remember, this is probably the last loan product that you do. You don't ever have to refinance. You don't ever have to pay title fees and origination fees. Literally, you do this one time. And the reason why people refinance so much in the first place is typically they want to access money. So this is an open-end product, meaning you can borrow against it at any time if you want to, but you can also not borrow from it and then pay it off, even faster. So a typical scenario for most people, this is principal and equity here. Someone would pay down principal, maybe there's some, college tuition costs, so the balance goes up and maybe they pay it down. Maybe they buy a rental property over time, they pay it off. Maybe they have a medical expense, and then finally it's paid off over 30 years. So I gave you guys that example at the beginning of my scenario. And so I found this product a couple months ago, and I'm in process to actually doing this loan. And this is actually what my scenario is. I'm going to refinance into the all-in-one loan at 640. Oops. I'm going to pay off my existing short-term debts. I'm going to pay off one rental property that I have. I'm going to move my wife's business income, my net rental income, and income saved from paying off debts into the all-in-one loan. And then calculation, please. So this is staggering. So my current level, I've got to pay another 346 payments. My total interest I would pay if I just don't change anything is $552,000. Or I can move it into the all-in-one. I literally have cut it down to 35 payments. I'm going to save over $467,000. And my interest that I would accrue is only $85,000 just by changing where I dump my income. Okay. Staggering, isn't it? It's
Hey,
amazing.
Miles,
Yeah.
can you pause for just a second?
Yeah.
I think we did get one question addressed in the Q&A there. But one of the reasons why I wanted Miles to join one of these webinars with us is because, as you can see here, this is his actual personal stuff he's done. He has used this himself. And that's very much the way Jeff and I operate. Everything we do and recommend to our clients are things that we would do ourselves or have done ourselves. So as you'll see later on the policy loan side, I'm going to show you my actual policy statement, yada, yada. But this is, Miles, this is your actual personal results of your working with
Yes. Correct.
I would add that as I migrated from Colorado to Dayton, Ohio, where we live now, the house we purchased, we bought it a year early. So we didn't have cash flow to do a new 30-year as well as keep our old 30-year. So we did the all-in-one loan also. So that allowed me actually just to pay interest only, but you would never want to do that on a long term because it could get unwieldy and get the better of you. But when we sold our house, then we were able to, pay down the loan note. And now we have a first position line of credit, and it's essentially paid off with the sale of our first house. And now we have the second house where we can still, utilize that equity when we want to, or keep it paid off. So we paid a fraction of interest on that deal. We even took a HELOC on our old home. At that time in Canvas Credit Union, to speak specifics, it was 1.99 for 12 months. So I used that equity to pay down, the little bit higher interest rate on the all-in-one to, again, have less interest as my interest cost. But it worked out perfectly for us, and it really opened my eyes to this opportunity.
Awesome.
Again, it's not right for everyone, but for those that it is right, it really is a good fit.
But Miles, from our standpoint, when someone wants to make overpayments on their mortgage, or they get a windfall of cash and they want to make a big lump sum towards their mortgage, our biggest concern as planners is, okay, but are we considering what your cash needs might be a year from now or 2 years from now? Because
Right.
Pamela Yellen in her book is always called, paying down your mortgage, putting money into a dead asset. But the way this loan works, it really neutralizes that typical, I would say, con to making overpayments to the mortgage, because you can still access your equity fairly easily.
Yeah, absolutely. 99.9% of all loans are a 30-year or 15-year fixed mortgage, but they're closed-ended. So once the money goes in, there's just no access to get it out. So it's not really safe for people. This is a product that's really safe, especially for people who are savers at the end of the month, that they're putting in more in savings than they are going out. And so You know, I'd like to run people's scenarios for them. If they do that, that's a great type of person that would actually really benefit from this. And as you can see, more income's going in than going out for me. So yeah, it's an amazing product. Calculations wise, I can show people what their payoff calculation would be based off their own personal scenario. And so that's what this calculator shows right here. So yeah, want to know how much you can save and how soon you can retire. If you have a second, text me your name at my phone number here, 970-308-0993. I can build a comparable to your current mortgage situation. Matt mentioned too, with helping him with his investment properties. I do strategic investment rental analysis starting at $150 an hour. And yeah, thank you for your time. I hope I didn't go too fast or too slow for you today. Is there any questions that I can answer for you guys?
Miles, there is a question from Bill. He made a comment of seems like a HELOC. Any comments on that, on the comparisons?
Yes, it's a 30-year HELOC. So it's basically similar to a HELOC. It performs better than a HELOC because it's over a 30-year AM. But it's very similar to a HELOC. Correct.
And then when you establish it, there's a certain percentage that they start with. So it's probably in the range of 74% of the value of the home. It's not 100%. Can you make more comment on that?
Yeah, you can go in this program, you can go up to 90% of the value of your home, up to 90%, even though there is mortgage insurance on anything above 80%. Okay. So if you have a lot of equity, most people just go up to 80% to avoid that. But that is what your credit limit starts at. So your home's worth 500,000. You can go up to 80%, which is 400,000. Your current mortgage balance is 100,000. You'll have access to 300,000 immediately.
Got it. And then Bill asked an additional question. What range of interest rates are you looking at? Mine was a 5-year rate, and then it can vary thereafter. I think that's actually a plus is, under the first position line of credit, the all-in-one loan, unlike a HELOC, HELOCs are based on current time, negotiated by the bank and you. Whereas in this structure, it's got a formula and it's going to stay with you for, the entire loan period. But kind of what are current rates? Are they
it's based off the 1-year CMT, which is anywhere from 7 to 13. The loan will actually give you a floor and a ceiling rate based on the current rates. So it can't go below and it can't go above. But remember, we're talking about simple interest and not compound. So I'd be happy, Bill, if you want to give me your phone number, I'd be happy to go through like more specifics within that.
Okay.
Yeah, I think you said it earlier, but you said it really well. The structure of the loan is more important than the rate. Yep. And I have a really lame spreadsheet that I'll show in a couple of minutes that will show you simple interest versus compound. And like with Bank on Yourself loans, what we often find is that your actual cost of borrowing is less than what that stated interest rate is because of how favorable the amortization is from the consumer standpoint.
Correct.
There's another question from Keenan. He's asked if your initial loan is under the 80% loan to value, but you borrow against the equity later and it exceeds the 80% loan to value, does the PMI get tacked on at that point? The mortgage insurance?
Yeah, you just can't go over that initial amount. It will. Okay. You can never go over it.
Right.
Now you can pay it down, and obviously that's the value that you could use later, right? So 3 years down the line, you pay it down 100,000. Yeah. You have now access to that 100.
Right. And I'm glad your chart showed that after 10 years, the available equity or loan drops on a straight line basis through the 30 years. That wasn't obvious to me when I signed on to mine. I didn't read the fine print, but it's important to know that. right?
Yeah, there are a couple of advantages to just regular HELOCs and this product, and I'd be happy to go, back and forth with someone on those.
Great. Great.
So,
Awesome.
yeah, great.